Most years, tax planning is just about tidying up your finances, but 2026 is not most years. We are approaching what financial experts call a tax cliff. On January 1st, 2026, the biggest tax overhaul in recent history, the Tax Cuts and Jobs Act of 2017, is scheduled to expire. If Congress does nothing, we revert to the old rules. For many, that means higher tax rates, a halved standard deduction, and a slashed estate tax exemption. The difference between planning now and waiting could cost you thousands. But before we talk strategy, we need to draw a very important line. In the world of taxes, there are two ways to pay less. One makes you smart, the other makes you a felon. It is crucial to know the difference. Tax avoidance is legal. It is the strategic use of the tax code, incentives, deductions, and credits written by Congress to lower your bill. Think of it as using a coupon at the grocery store. You are following the rules to keep more of your money. Tax evasion is illegal. This is underreporting income, inflating deductions, or hiding money from the IRS. This isn't strategy. It's a crime with severe penalties. Today, we are strictly talking about avoidance, using the law to your advantage. So why the urgency? Unless new legislation is passed, here is what happens when the ball drops on New Year's Eve 2025. Income tax rates rise. Today's historically low brackets, like 12%, 22%, and 24%, will bounce back to their pre-2018 levels, 15%, 25%, 28%, and up to 39.6%. Standard deduction halved. The standard deduction will drop by roughly half. This means millions of people who filed simply will be forced to go back to itemizing and tracking every receipt to get a break. The estate tax squeeze, the amount you can pass to heirs tax-free, is currently historically high. In 2026, that exemption is cut in half. If you believe tax rates will be higher in 2026, why wait to pay them? Consider a Roth conversion. You take money from your traditional IRA, pay the taxes now at today's lower rate, e.g. 22% or 24%, and move it to a Roth IRA. It then grows tax-free forever. You are effectively buying your tax break at a discount. Usually we try to delay income to delay taxes, but with rates rising, the opposite might be true. If you're a business owner or have control over your bonuses, it might make sense to receive that income in 2025 to pay 37% federal tax rather than waiting for 2026 when the top rate could jump to 39.6%. For those with significant assets, the estate tax exemption is the big one. You currently have a bonus exemption that lets you gift millions tax-free. When 2026 hits, that bonus disappears. The IRS has confirmed that if you use the higher exemption now, they won't claw it back later. This is a limited time window to transfer wealth to the next generation tax-free. The tax code is a living document. It changes. The sunset of 2026 is the current law of the land. While Congress could step in at the last minute to extend these cuts, betting your financial future on political gridlock is risky. Review your plan, check your brackets, and most importantly, move from evading the conversation to avoiding the unnecessary cost.